Evening traders, evening, good evening, good evening. You like that? You like that little picture? Do you? Do you? Doing things a little bit differently this evening. We will, well, you'll see as we progress through. Dump the slides for this virtual whiteboard software because I wanted to kind of dig into the charts and done a flick through trading view and back on here. So we will see how it goes. Not abandoning slides. I think they're useful to keep me on track and keep me, on point with what I'm trying to talk about. But let's do something a little bit different today. So we'll start in a moment. Markets are interesting. Obviously, Nvidia, all about Nvidia. What's a mere $200 billion move between friends? What's it? $4.2 trillion market cap now. A dollar, obviously. You FX traders getting a little bit of action in the old dollar after the data. Gold's off a touch last time I looked. Yeah, crude oil still off a little bit. What have we got? Nasdaq floating around. Dow's getting a little bit under the cosh. S&P down a smidge. Yeah, mixed bag out there. A mixed bag, and Bitcoin pulling back after its monster breakout. Look at that chart actually. How far are we getting? Okay, we had a good run up to 123 in a bit, and we're pulling back a bit now. Healthy stuff if you are a crypto bull. What else? Alibaba bouncing, as you might expect from the Chinese news. Are they going to be a bit more relaxed about China, etc., etc.? Mag 7, not much going on there. All right. Anyway, whatever you're trading, however you are involved in the markets, I hope you're having a good week so far. Where are we? Tuesday. It feels like Thursday. I don't know why. It feels like Thursday. Okay. So today I want to cover a couple of setups that are at the opening bell. So these aren't opening range breakout trades. It's not the opening range breakout setup. Everyone knows about that already, and I've kind of covered that in detail. And actually, there is some downside to the opening range breakout, which we'll cover in a moment. And kind of these combat those to a certain extent. So these couple of setups that we're going to cover really allow you to take advantage of the different conditions that, especially at the moment, like these. Then you see the chart examples that I've included for you. These are all the last couple of weeks. I've not like cherry picked back in 1942 and gone, look, that setup worked then. There you go. See, it's a good setup. These are all kind of, last week, last couple of weeks type of stuff. So, take it or leave it type of thing, but it's valuable. Okay. Right. Let's scroll up to the serious stuff here. Serious stuff. Hopefully this will all work out nicely. So you guys should be able to see that. I can see that you can see that. There's a little bit of blur in there. We'll make do with what we've got. Okay, two setups for navigating the open. How to approach the first hour with structure and clarity. And what I mean by this is, I think that, listen, if you trade the open, whether you trade the DAX, whether you trade the FTSE, whether you trade Nasdaq, whatever you trade, right? The open can be a really good place in the market and really a lot of opportunity to trade. It can be a nemesis, it can be unpleasant, but it also can be super valuable. And I think that also if you're trading currency pairs, even though there's no bell as such, you can use this as a framework to think about the open, if you like, the Asian session, London session, US session in a slightly different way. And I think that that's the key when thinking about any setups, guys, is like, yeah, you can be mechanically rule based, and these are rule based to a certain extent, but it's more the framework and thinking and the model and saying, okay, this is my roadmap, and this is how I'm going to navigate it if I see this. This is how I'm going to navigate it if I see that, and really thinking in that way as opposed to mechanical if this then that type of thing. And everyone's different. You can obviously approach it as you like, but I think that's the best way of thinking of things. Okay, this quote from Toby Crable is from this book here. This book, quite expensive book actually, as far as books go. It's not an antique or anything, but it's quite an expensive book. And Toby Crable says at the beginning of this, in the first couple of pages, he says exactly that. As a trader, my purpose is to develop a framework for understanding the market. And by the way, he wrote this. I've talked about this book before. I won't go on and bore you with this, but this book was published in 1990. I think it was before that. It's might have been a second edition actually. In 1990. I think he did before that. Anyway, the point is he's now he manages a couple of hedge funds, Toby Crable, excellent trader, did a lot of study about the opening range. I hold it for you can actually read it. Is it flipped? It might be reversed. Anyway, it says day trading with short-term price patterns and opening range breakout. So he did a lot of work studying the open, and he still runs a fund now, or one of his funds actually has a short-term holding time. Who knows if he still uses the opening range breakout? I'm assuming he uses some type of modeling at the open, and again, some sort of framework to help his fund navigate. The whole time is like a day for one of his actual funds, so he's still a super active uh, day trader. He's a day trader, right, for his fund. So if we think, okay, let's why I'm saying that, let's assume there's edge there, even if you don't think there's any edge, and you think, oh no, I know what's he talking about. Let's just look at the people who are running funds and have assets under management. If these guys over a 35-year period have developed strategies that still work now at the open, it's worth us focusing our energy so that we can kind of extract edge from the open. So today we're going to talk about, let's just kind of run through why the open matters first. So let me define the open. I don't think I define the open. So the open to me is when the stock exchange, excuse me, bell goes off. So 8 a.m. UK time for DAX, for FTSE, for European bourses, 2:30 UK time, 9:30 Eastern time for the New York Stock Exchange when the Nasdaq opens, and that's just when we get this kind of cash flow move. I know and get that there are 24-hour products out there, or almost 24-hour products. Futures trade overnight. Synthetic CFD products, of course, trade overnight. Pepperstone offer multiple markets overnight, some shares overnight as well. But the liquidity in the main market movement happens when the bell goes, when the stock exchange is open. And you see that with the currency pairs, right? The currency pairs start to get more active and more spicy when the stock exchange is open, because there's also things like the options are open at that time. You've got much more liquidity and much more different order types available to you as an institution that you don't get after hours. If you're an institution trying to buy massive amount of Nvidia shares, you might have been able to do it last night because there was a lot going on, but under normal circumstances you have to work that through when there's high liquidity. So the opening bell, even though the pit doesn't exist, so to speak, anymore, there's still a lot goes on at the open that another sort of different instruments is the word I'm looking for, different instruments like options where money flow can flow much more easy. So it's important, right? So it's important. Even in a 24-hour environment, it's important. So this is when you get the volume surges, you get urgency spikes, and I think it's a good time to look for opportunity. If you're an institutional player, hedge fund, money manager, government, even company trying to do whatever, if you're hedging exposure or whatever it might be, doing buybacks in your company, if you're moving stock around, you get the idea, right? It's when you can do this stuff, and you get a glimpse of, sometimes, not always, and we'll cover this in a moment, the open can be, for an active trader, it can be a real nemesis. And I'll give you some kind of roadmap to look at to help avoid it if it's not really your thing. And actually, we can take advantage of this because very often retail traders are going to overreact, and we see this quite often. Especially in the first kind of couple of minutes, you see, and if you go kind of dig into things, there's not much volume done sometimes, and then it really picks up as the kind of things settle down. And so, if we're smart, we can see people who are trapped in a couple of this. In the setup I'll show you, the second setup I'll show you is all around people getting trapped. Really, it's an information-rich window. False movement traps we've covered, and the thing is as well, there's two things to think about here, right? If you trade the open well, so if you're able to trade the open, and I appreciate everyone gets the screen for the open, some of you can, it kind of sets you up for the day, and it's nice. You're going to go, great, I've started off green, I've got a good cushion for the day. Maybe you don't even trade the rest of the day. I know many traders who just trade the open, and that's it. They go, hey, I'm going to trade a couple of hours at the open. I see my setup, see my play. If I execute it, win or lose, I walk away. If you can trade the whole day, sometimes having that cushion helps psychologically. Now, let's flip it on its head. Of course, if you have a bad open, it can really upset the apple cart. Now, before we dig into the intricacies and I kind of show you the setups and some of the chart examples and stuff, of course, this is not orb, not opening range breakout, but I want to remind you guys of, obviously, the risk disclaimer. please understand that if you're trading a leverage product, if you're trading a spread bet, a CFD, in fact, anything like that, leverage works great. You've got a nice opening drive, you've got a full boat, it's lovely, things are great. You're in a nice opening drive, you've got a full boat short, it stings. So the double-edged sword of leverage, please, I know many of you understand this, but I have to say this, trading is super risky. Understand what you're doing, how everything works, how to manage risk, and also obviously trade only with money you can afford to lose, because as we know, the failure rate is high for traders. But you're not here to lose, you're here to win. And hopefully stacking this knowledge, stacking layers of edge, as I like to call it, managing your risk, picking your great trades, being patient, having the right mindset, having the right playbook, all the stuff that I try and cover, help you out, is going to put you in that the opposite side of the retail investors who are mostly losing money. But please be aware, super dangerous game to be in. But if you're okay with it, you understand the risks, then let's carry on. Okay, this is going to work for me. Okay, I can zoom it that way. That's good. And this is a new tool I'm using. If you didn't hear me at the beginning, this is a new tool I'm using. Normally we're here with the slides. The slides are very easy, but I've got this kind of virtual whiteboard that I can zoom in, zoom out, and go around and stuff. And I think it's going to be great for the chart examples, but you might find it going into the size of a pin, zooming right in, and while I calibrate to this stuff. I've got myself set up here ready, but we'll try it out. We'll see. It was quite nice to kind of put this stuff together actually, because when you're doing the slides, I do the slides and sometimes I want to put an extra example in here and then that doesn't make sense. I'll have to edit this and do that and I move this around and I'm kind of like, no, but I want to say this. I want to cut that out because that's dead weight and repeats them. You know what it's like. And so often you kind of, because it's a linear flow, it can be a bit of a challenge. But with this thing, you'll see I can put kind of screenshots in addition. We go sideways. We're going to have a little bit of a journey tonight. I'm telling you, we're going to have a little bit of a journey. So we'll see how this goes. So a little word of caution, right? The open may not be for you. And I say that could be the US session open, it could be European session open, where you're trading currency pairs, whether you're trading the DAX, FTSE, NASDAQ, whatever. You might take an active commercial decision not to trade the open. And that might be the correct decision for you. Okay, so not many people doing webinars say, hey, this might not apply to you and don't listen anymore if it's not for you. But why I say this is, if you are struggling with maybe trading on tilt, if you are struggling with over trading, getting sucked into trades, the open is a real seductive beast, seductive mistress, if you like, because there's a lot of volatility. There's a lot of stuff swinging around and it can entice you to take in trades that you otherwise wouldn't normally do. And so why I say this is that, if you are a developing trader who is, trying to master his craft, trying to master her craft, it might be better to observe the open and then plan your trade for later in the day, your levels, once you've got a kind of once you've calibrated to conditions a bit, because the open it can look the strongest thing in the world and then just rip your face clean off. It's like that. That's the game. And if you are going to get involved in the open, please just understand that if you, just make sure your risk management is on point, because it can, and the open can start off so kind of calm and relaxing, and then just bang, it just absolutely goes into stratosphere. And if you're there, I'm going to say worst case scenario, adding to losing trades and surrenders, but holding on to a trade hoping deer in headlights, that's no good. So I want to say this to you because there's no panacea, there's no holy grail out there, and I'm here kind of with multiple decades of experience to share with you what, if this is right for you, then this is valuable. If it's not right for you, that's okay too, but you do what's right for you personally as a trader. And I just want to add that little warning that, hey, the open can catch you out, but it's also very, very offers a lot of opportunity and potentially very lucrative if you get it right. So there's like the margin thing, right? It's a double-edged sword. If you get it right, there's nothing better than getting a nice opening trade, setting you up for the day, for the week. There's nothing worse than being caught out and starting the day on the back foot. Okay, so high volatility can be high, so is risk. First 5 minutes is often a trap. There's no setup, I think, that you need to take in the first 5 minutes. My personal opinion, others may differ, unless you're on a higher time frame thesis that you're bringing down, you're buying the opening print, but that will be a different play. You've done the higher time frame analysis, maybe you've seen something breaking out, maybe you want to buy it at the open, but it's a considered purchase or a considered trade at the opening print, very, very different from this, which is calibrating to the open, seeing what happens, and then making a decision based on that. Two distinct differences there. So I think there's nothing really you need to do as a trader, as a day trader, even a scalper, in that first 5 minutes. It can be super volatile, very difficult to get a read, but 5 minutes is often enough to calibrate. Now, we're having a conversation with traders in the call the other day, and talking about how long to wait out. I think 15 minutes is too long. And this, again, it's personal. Some people like to wait 15 minutes, but if you're trading the orb, obviously opening range breakout, that's what you're going to do. You're going to use that 15-minute range. But I think a sweet spot is just waiting for that first 5 minutes, because it's so noisy, so volatile. And I think it's very difficult to get a read. Now, if you tell me, Mark, I got a great read after 2 minutes, I'm killing it. You carry on, double down on what's working. I'm not going to tell another man how to trade, but I just think let that 5 minutes, let the dust settle. And also, let's be realistic, right? We're human beings. What do we do when we come into the trading day? We come in, we're excited. We want to trade. We enjoy doing this. That's why we're here. And so very often you can come in, rubbing your hands, you're all ready. And the first sign of a movement, click, you're in. And it just doesn't, so just 5 minutes sometimes to calibrate yourself, to see what's going on, settle in, can be enough. If you need more, fine. 5 minutes, I think, is the minimum. And be aware, mention this, one bad trade can really set you on tilt. It can really kind of ruin your trading day. And I just don't think you have to trade every open, of course. Don't let adrenaline or anxiety drive decisions. If you're really pumped up and you really just wait, just let yourself, center yourself, do some breath work, calm yourself down. Just go, listen, maybe I need to sit things out, just chill out a bit. I'm making a decision from the wrong part of my brain. Is it the amygdala at the front? Believe it is. You don't want the decision there. You want it based on the kind of logical side of the brain. And the open is a real place for disciplined traders. So as I say, reiterate, and a broken record, appreciate it, but you have to be absolutely locked in with your discipline, because the open will absolutely recognize a chink in the armor and tin opener it right out, expose your heart. That was a bit graphic, wasn't it? You get the point, right? It's not going to be very good for your capital. So just be aware of that. And as I mentioned, if you need to avoid the open for mindset purposes, then do that. Okay, we're going to focus on the opening reversal. Let me zoom in. We're zooming in and out. If people are getting seasick here, we've got it. Okay, loads of chart examples, but you like my little candles I drew? I drew these just for you. Look at them, man. They're so pretty. Even though technically after I drew that, I was like, that actually can never happen, Mark. There's the close of the candle and the open the candles there. You got a gap in your 1 minute. I mean, what's that, a data issue? Forget that, because I did it and then I kind of copied those out. But you see what we've done here. Here's the opening print, and here's the kind of open line. The market drives in one direction, but I'll cover the parameters all a second in a moment, how far to drive, all this type of stuff. But the market drives off in one direction, it reverses back, trades back through the open, trapping those early traders. And I call this the open reversal. This has been happening quite a lot. Like I say, I don't have to, go through my playbook and go through some of the screenshots I've got. They were really recent, right? So I didn't have to do much digging to find this stuff. This is trade setups that are happening now. And in fact, today we got exactly this. You'll see. Okay, so let's look at this. Let me zoom in on this. So here is an example. Let me see this. This is working all right. Okay, so this is the DAX. It opens here. It drives off. This is a 1 minute chart. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Comes back through the open and it peels out through the day. So the idea is that it's catching traders out by people buying this opening drive, and it's peeling back over. Another example here we've got on the NASDAQ. I've used a 2 minute chart because I wanted to cover the rest of the day. Same type of thing. Rolls back. This is the inverse. Comes down, comes back up, back through the open. This wasn't a kind of trend type day as we had on the DAX. However, it was that trap that was set. Now these are, there's a simplistic but simple works. And like I say, this is a framework. And if you can categorize the open type, you can say, hang on a second, I can trade this, or I can use it as a model for a calibration technique for what the day is going to be like. Okay. Another example here, we had the NASDAQ open We had 1, 2, 3, 4, 5, 6, 7. This is a little bit tight for me and rolled over. I'm going to go through these a little bit more detail. I'm just going to skim through so you can see, and then we'll dig into the actual intricacies of the trigger, the stop, the target, etc. Just giving you some kind of examples so in your mind you could go, I kind of see what's going on here. On the DAX, same type of thing, driving up. This one took a while, but eventually kind of broke through the open. You could argue you probably would be stopped out on this one, but this is the real world. We're not cherry picking stuff. Okay, so you've got a few examples there, and you can see what we mean. So just for clarity, it's a drive up or a drive lower that reverses and comes back through the opening print. So the important thing to add to your chart here is the opening print. Now, there are scripts that are available to do that for you automatically. I like to do it manually, get it on there and just stick it on the chart so I know where it is. I can see exactly what it means and all this type of stuff, and I can be sure that it's in the level I want. So it's the open of the stock exchange session. You're drawing that chart, and these are the kind of examples of what it looks like. Okay, so what are our let's think about our triggers or our ways to get into this. So the preferred, I think, is that you're selling short or going long as the open breaks. So in this example, it rallies off, comes back, and as it comes back through, you're getting on board on the short side. And also, I probably should have mentioned, guys, with the risk disclaimer, like this is not me recommending any strategy for you. This is not me saying anything other than, hey, this is fun to learn, and maybe you go away and kind of look at it and dig into it yourself. And I didn't add this because I'm not using the slides. Whatever we talk about stuff like this, the way you get the benefit from it is to go and use it as a seed, a sparks an idea in your mind and go, I quite like that. Let me dig into it, do my own due diligence, do my own research and work out if it's right for me, my risk tolerance, the way I trade, my discipline levels, all this type of stuff. This is not meant to be kind of plug and play. This is meant to be, okay, I like the idea. Oh, I'm actually doing this already. Can I tweak and adjust for my trading? Just thought I'd mention that because I didn't mention it earlier. So setting short as the open breaks. So you get the trap set. Everyone's like, off we go, we're off to the races, they're long, it rolls back over. And why, by the way, why we use the opening print here on this specific setup is that the open is, if stocks are opening, the specialists have got to agree on an open. In the FTSE, there's a kind of an auction. I'm pretty sure there's still an auction process. There was 15 years ago when I traded the FTSE stocks. I haven't traded them for a while. I'm pretty sure it's the same, right? You have this auction process, comes in, everyone puts their orders in, there's a randomized time, and the market opens. So regardless of the kind of operations of how it works, ultimately it's an agreed upon price, right? At that point in time, every market participant has agreed on that price, or everyone who wants to be involved in it, because that's how the price is made, right? It's an auction process. You buy, your sellers, and they're kind of matched, and that's like an agreed upon price. It's used as a reference point for many algorithms, right? So it's it's not out of ambiguity. Like if you're using a trend line, depending on the angle, oh yeah, there's that, or a support level. No, the open is a finite level, as is the high, as is the low, as is the close. It is an absolute level. There's no doubt about it. So if you can plot that on your chart, everyone else is looking at that. And everyone else is looking at price in reference to that opening print. So when we see this trap set and then we see it flow lower, like, hang on a second, there's a lot of things going on here. And I'm kind of just going off piece slightly for a moment. Why I think this works so well is that I think there's a lot of kind of retail, not necessarily retail traders, but a lot of kind of scared money, quick money, if you like. I don't like using this smart money idea. That's not my thing, but I think there's a lot of people kind of jumping on momentum. And then the actual bigger move, the real move, comes when things have calmed down a little bit. There's a bit more liquidity in the market, spreads have narrowed. And then in this case here, it's like institutions about hitting the bids, algos are kind of kicking into gear. And then when it's going back through the open, it's basically saying we're undoing all of that work and we're still prepared to pay lower and lower, or sell at lower and lower prices, because we've got a lot to do. Now, they may have the order done in a couple of hours or an hour, you don't know this, but that's the thesis. The thesis is, hey, things have settled out a little bit, and now the true intent of higher time frame money is revealed. And when it goes back through the open, rather than just pulling back and revisiting highs, that actually, or the thesis, the hypothesis is that sellers are prepared to pay lower and lower prices, in which case they're more time sensitive than they are price sensitive. We have this concept of price sensitivity and time sensitivity, right? And markets move when people are not sensitive to price. And what I mean by this is, and I've said this before, so bear with me if you've heard this concept, but if you want to sell something at 100 and you're price sensitive, if it's a 99, you won't sell it. If it's 97, you won't sell it. If it's 101, you'll sell it. Yeah, I'll sell it because I want 100 or more. But if you're time sensitive, in other words, I don't care what price I get. I just want to sell it. When it's at 98, you'll sell it. 100, you'll sell it. 95, 85, 80, 79, you will sell it because you're no longer, and market participants go in one of two, generally one of two. I'm oversimplifying it, but you get the idea. So when we have a higher time frame that's super time sensitive, i.e. I need to sell this now, that's when we as retail traders can jump on the coattails. So this, along with any other kind of idea, is all we're doing here is gathering information to say, hey, I think higher time frame isn't price sensitive. They just want to get out now. I'm going to ride their coattails and I'm going to kind of play that trade, whether it's an A to B trade or a trade to hold for the rest of the day, which we'll cover in a moment. Anyway, I've got off topic. Let's come back to some of the examples. So we can scroll sideways here, boys. We can start scroll sideways. So in this example, right, you see this kind of market start to drive off. Yeah, there's your 8 p.m. Of course, not 8 p.m. 8 a.m. Market opens. You've had the 24-hour session, but things kick into gear. Like I explained earlier, this is why we're looking at this. And market starts to drive off higher, finds a bit of resistance, rolls back over, and this is actually quite a nice one in a way because it's got the traditional setup there, which is goes to the high side, rolls back over, you sell it through the break. And if you were using this sell short as the open breaks, this is exactly how you'd enter. You would enter. I can't remember. We can get right here. Look at this one. You can enter, as the price goes through there. So obviously you could use a rest in sell stop order to get into the trade, to open the trade, or you could hit the market or whatever you want. Now, those of you, astute of you who are kind of watching this sort of price action, you see when like this miniature support types to break, you might even want to front run it and go, actually, yeah, I'm gonna take this because this is really aggressive. Now, this is a great example. It wasn't even that long ago. It rolled right over and ended up kind of really capitulating. Well, not capitulating. That's a bit excessive, Mark. It rolled over through the rest of the day. But this was this area here. What's my little drawing? This is why I did it. This is why I did it, guys. This is why I did it. This area here needs to be white. This, geez, that doesn't need to be that thick, does it? Does not need to be that thick. Wait. Bear with me. Okay, this area, that's better. This area here is like the momentum, and you're selling it on this break here. And that's the beauty of this trade, is that you've kind of got all these participants now trapped. It hasn't gone too far up. Bearing in mind, the higher it goes and then it swings back over, the better the trade, really. And you've got all these participants now who are kind of trapped. They have got to liquidate, and this is where the real move is happening, the real volume's coming in. And so that's when things start to get a little bit more interesting, right? So that's the traditional kind of sell the break. Right, now what else have we got? We've got wait for the bar to close. So if you're a trader who says, hang on a second, I don't want to, and we'll talk about this in a moment, but context plays a key role in this. And I've got kind of a few guidelines that I think are valuable for context. In other words, a higher time frame, all this type of stuff. So that's going to influence how you execute this trade if you choose to deploy this. But I'm just giving you some other ideas and ways to do it. So waiting for the bar to close. Now, if you looked at that example back here, you would be kind of, is that one? No, it's not, is it? You would be here, which isn't too bad, right? But sometimes, what bars are like, and I'm using 1 minute here, it could have a real big extension. You feel like you're chasing it. You may feel like you're right, but don't forget there's 2 points to a trade. One is direction, one is being able to manage the risk effectively. And you may be right with direction. Sure, it might roll over for the next hour, but what if it pulls back 100 points first? So we're trying to get that, make the most amount possible with the least amount of risk. But another way of doing it is to wait for the bar to close. So this is actually quite a good example here, because if you had taken it on the break, you'd have been here. You'd have taken a little bit of heat, not a lot. How much heat is that there? It's shrapnel, isn't it? But if you wait for the bar to close, you'd be here. Now, of course, you give up a potential better entry, right? But you maybe have a bit more confirmation on what you're doing. So this is the same type of thing, right? Driven up, driven up, driven up. Starts to find a bit of resistance up there. Now, some traders might be like, oh, well, I'll sell at the resistance. Fine if that's your thing. But the idea of this is you want to see the whites of their eyes. You want to see the truth of what potentially could happen. This rolls over, and this one obviously had this similar type of thing where you had this kind of big drive to the downside. Okay, let's go here on this, and bonus marks when you go back through the low, because this was slightly different, right? This low was the actual opening print. When you go back through the low, just creates a little bit more extra momentum in the trade. There's another one. Oh, there's another one here. Okay, this one's a FTSE 100 for you FTSE traders. You sadists, you. Same type of thing. This was the same day, I think, rolled over, and here would be your entry as if you were taking on the bar break. If you're taking the bar close, your entry would be here, and this then crumbled and crumbled and crumbled and crumbled. We're going to talk about targets and stops in a moment, but I just want to kind of get clear in the mind the idea. You mark the open, let it do its thing, rolls back over, and you're taking it either on a break or on a bar close. And again, the thesis is you've got the trap traders there. You've got the true sentiment shining through after the initial momentum and shenanigans. Okay, another way of doing this is to wait for a little pullback. Now, this is obviously the most aggressive. The selling short as the open breaks is the most aggressive. You want to get in as it rolls over, and you want to hit it hard. Now, if you're waiting for the bar to close, you're just thinking, hang on a second, maybe the higher time frame is not exactly right. Maybe it's not the greatest scenario. The regime's not that good. And the pullback is like, okay, I like it, but I want to kind of improve my entry. Now, you obviously, the game, guys. You give and take. If you wait for the pullback, it might just run on without you. But I know many of you like to only wait for the pullback. Your thesis is, or your kind of model is, I need to make for a price improvement. I need to sell on red. I need to buy on green. If I'm day trading, I'm trying to get a price improvement, and that doesn't mean chasing stuff. So this is one way of doing it. Okay, so example here on the NASDAQ, you've got this opening drive lower, trapping a lot of traders, comes back up. It's a little bit scrappy, right? But you don't take much heat if you're long on the break, but maybe prefer to buy a pullback. So any of these type of things, you kind of go, hang on a second, we've broken back through the opening print, we've broken back through the high, if you want to add that. We're kind of bull flagging here. That's a pullback. Let me take it. Now, this isn't a perfect trade by any stretch of imagination, because you only got that much chunk of move. And what's that? It's about a $40 move, right? So, it's not cherry pick perfect trade, but you see the concept. Trapping traders down with quite a big downdraft, right? And then it rolls back over. Okay, actually the open would be that back down here, but you get the idea. Okay. Whoa, it's back. This is, I'm a little bit cautious of this way of getting in. So as the open, say you have the opening drive, comes back, I'm a little bit cautious of waiting for it to pull back right until the opening print. Why? Because you just end up, if you're not careful, you end up being in a rotational market. So the market's rotating around. Well, a higher time frame is much more important. Okay, let's keep things moving. Keep things moving. Okay, so that's the opening reversal. I like it. It's been happening loads recently. If you like it, keep your eye on it. Add your own flavor to it. Do that. All right. So let's move on to this, which is similar. And don't forget this. I would still class that as a momentum trade, but with a trap. So you've trapped traders. You've now reversed. Great. And it's very good in gap situations. It's very good in catalyst type situations. It's very good when the higher time frame is in your kind of aligned with the trade you're taking. There's lots of things we can do to help that edge kind of really deploy itself. All right, this one here is called the opening drive. So the idea here is, with the opening range breakout, you're waiting for a movement in one direction, aren't you? You're taking a specific breakout. This is a little bit more aggressive. This is basically saying price should drive off in one direction off the opening print, pull back to the 9 EMA on a 1 minute, and then continue in the direction of the move. You can use a 10. One thing's going to make absolutely no jot of difference, but I'm just using this as a kind of framework to help you. This is the kind of the visual here. Drives off in one direction, pulls back, and off it goes. Okay, so example here of the day on the Dow, we had the open, it drove off. It actually, this is an added bonus, it trapped a few people. It drove off. You had the first touch of that 9 EMA, and it just kind of carried on and on. Let me show you something a little bit. Here's another one here on the NASDAQ. This was a real aggressive one. There was the opening print. Rally, 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 rallied. It's a bit late. Would you still want it? Maybe you wouldn't, but it's in the direct higher time frame direction. Everything might be lining up for you. You're buying this, and then you kind of got a little bit more, but it rolled over. But this is the idea now. You know, perfect world, you'd have the touch here. It didn't do it, so you can't second guess it. But that's in a perfect world. It drives. You have a really good drive. You're avoiding the FOMO because you're waiting for the first 5 to 7 minutes. You're not getting involved. And then when it's kind of doing this, you're letting for the EMA to catch itself up. It's obviously, if you're trading on a regular trading hour session, it's going to take 9 bars for it to catch up. It's a 9 period. And then you're kind of buying it on that consolidation as the moving average catches up and starts to nudge it. So this is only when you get that drive. You're not trading it in chop. You're not trading it in kind of any other environment. It's just on that drive. So here was one to the downside on the 10th of July. NASDAQ again. There's your open. Rolls over, rolls over, rolls over. And then you've got these touches here. Touch, touch. And it just this. I know for some reason, when we do get the drive, it kind of hugs that 9 for quite a long period of time. It's a good. I'm not a big moving average guy. You know me. If you've watched any of my stuff, I'm not a huge moving average person. But in this specific setup, it's the charts are the charts. Sometimes it's hugging that moving average very, very nicely, and you can also use it as a trail and say, well, I'm going to buy on that first kind of touch here. This touch here would be first, right? And I'm going to hold it and hold it and hold it until we kind of get a close above, which would be here. So, and I'm always wary of sharing this because I know a lot of hindsight traders are saying, look, I'd buy here and I sell here. But we're looking at it as a framework, guys. We're saying, hey, if we like to trade the open, let's box that open off. Likely to be chop, default no trade. Get my levels prepared for the rest of the day. Could be an opening drive. I don't want to chase. I don't want to fade. I want to do my wait for a pullback. This helps guide you using this 9 period EMA, or it's a full scale chop. It's a full scale trap where everyone's caught and now I'm taking that. So it helps you bucket that open so you know how to potentially trade that moving forward. Okay, another example here is on the S&P. This was real text, but this is what you want actually. You want the gap, higher time frame in your favor, gap up, multiple drive, comes back, tags that EMA, and off we go. You'll probably be a bit annoyed that you got stopped out if you were trailing it here, but you get the idea. You see how we get into this trade. So long on the first touch is I think the preferred, because you kind of have this urgency about it. It's a momentum type trade. You don't want to be too late to the party. But other ways of doing it is you long when you've had 50% of the touch candle range. So what I mean by that is this. So imagine this is going to be a thing in it. So imagine this is the candle that's touching the 9 EMA. So that's your 9 EMA. That's the candle that touches it, obviously. So you take that candle, and you say, okay, I'm going to use 50% of the range. Now, this isn't always going to formulate a red candle. It might touch and rip off, in which case you can't do it. But if you this is a way to kind of be a bit cautious, because obviously what you don't want is for the candle just to keep forming and forming and forming. You're going long here and you're like, I'm kind of a bit stuck. We'll talk about stops in a moment. So this is a way of saying, okay, well, if it kind of closes below, I'm not just going to buy here. I'm going to obviously got to make the decision beforehand. You don't know, right? But it's another way of doing it. We're not using hindsight and saying, well, I wouldn't have bought there. You got to do or you don't. But one way of doing it is to say, if I'm cautious, I want to wait then for the candle to come back up. I'll take 50% of the range of this candle, whatever that may be. And as it comes back up, I will buy that there with a stop below there, which kind of mitigates this just peeling back over and maybe just kind of coming back and being a choppy type day. So it's one way of managing that risk by using, and it's an arbitrary thing. 50%, there's no magic number there. It's just basically saying, well, I want to see it come back in my favor, is one way of doing it. Okay, another one is you buy it as it kind of breaks back through the high. But as I've said here, I don't like that because very often I feel that's such a chase. Personal preference, it depends on how big this drive is, right? You and I both know you've had a very, very, very big drive before that 9 EMA catches up or before it starts flagging. Very often that's it. And this is where it comes back into mapping your market. You know how much the drive typically is on the 15-minute chart, etc. Okay, let's keep things moving. I didn't think it'd be enough. There's so much to cover. This was today. I didn't like it because we're against the trend. We are, and we didn't really have that much. It was quite choppy. But today's this is kind of where it was. We had to drive lower, 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 lower. Pull back to the 9 EMA here. I say I didn't like it because I didn't like the. We're against the trend. We're gapping up. We're on good news. We're all-time highs. Man, you got to be so careful taking momentum shorts in this market. So careful. But this is kind of how it will play out. Comes back, tags the 9 EMA, rolls over. The rest is history. But you get the idea. This is real world stuff. Even better with the trap. We have this example here. So hopefully that's clear. There's two different ways that we look at the open. The opening drive is we're seeing momentum move in one direction. 5 minutes, 6 minutes, 7 minutes, longer the better, really. The 9 EMA catches up to it, and you use that as a framework and assuming it's going to bounce off. And the thesis here is that there's aggressive buying, aggressive selling, the hammer's gone down, the algos have got kicked into gear, there's no room for ambiguity, and your job is to not FOMO into it, but to wait for a structured place to take it and be able to quantify the stop versus the open reversal, which is some businesses done in one direction, flips it on its head, comes back, traps a chunk of people. And this is happening over and over and over and over again at the moment. If you like it, go back and look at your charts and you'll see this framework is, that's why I wanted to cover it now, because it's happening a lot now. Okay, let's go what to avoid. So avoid, this helps you avoid being being impatient and chasing stuff you don't want to chase. That's why you're waiting for certain things. The best setups have multiple stages. The first phase, then the second phase, and the third phase. So the first phase is the drive, the second phase is the pullback, the third phase is the bounce back up. The trap is the first phase is the rally, the second phase is the pullback, the third phase is the break. Often structuring these by saying, hey, the trap's set, the momentum is there, seeing something, that's not necessarily your trigger. The signal is not necessarily a trigger. I think Al Brooks said this. It's like his trigger candle is not necessarily the signal candle. That's right. Trigger candle, not necessarily a signal candle. Same with this. You might see the rally, that's the signal, but you still need the trigger, which is the pullback to the 9 EMA. You see the reversal, but you don't take it until it comes back through that opening print, because that's the key point. And it's up to you to adjust and adapt how late or early you do it, but separating the signal, momentum, reversal, trap, and the trigger helps you really kind of not get caught up in nonsense stuff. So trading too big too early, you can get caught out in the open. We know this. Assuming direction from the first, we've talked about this before, you don't get seduced by the opening swinging around. It can just really suck you in, guys. Be careful. Overreacting to news or headlines saying, oh, you know what, wow, I think I'm going to drive off because Nvidia's now exporting chips to China. Buy the opening print, get your face ripped clean off. Fading strength or weakness without reason. You get the idea. Forcing a trade using a tight stop. So example here on this DAX is, listen, this is reversed too quick for my liking, even though technically speaking this was a profitable trade. If you took this as per the rules, this is way too quick. 1, 2, 3, 4 minutes is not enough for me. If the reversal's in play, it's got to go up and do some business up here, trapping as many and then coming back down. That's a good trade you want to take. This is too much. Now, you might disagree and say, I'm happy to take that. Fine, but I don't like that type of thing. And this is a choppy open. So, you've got these dirty candles, red, green, red, green, red, green, even though, maybe it came back down here. Even if it came back here, I wouldn't be wanting this. It's not clear enough. Use your judgment as a discretionary trade and use your kind of ability to spot, good type of trades. And again, I think this is too, well, it's not too bad actually. This 3 minute candle, in fact, we're on a 3 minutes, so yeah, it's not too bad. If it's a 1 minute, no. So you're okay here. 3, 6, 9 comes back up, even kind of does a little bit of a liquidity grab, whatever you want to call it. A Wyckoff spring would be my preferable way to name this, and then you kind of get this rally back up. So hopefully you get the idea of what we're looking for here. Okay, so let's talk about setting the targets. Whoosh, in and out. Okay, so targets here. In fact, before we do targets, let's go to the when to consider pressing, because that's going to help your targets. So when to consider pressing. So this is going to help you determine your targets, right? And this is where your discretionary skill as a trader comes in, because we can kind of talk about rules and frameworks and ideas and trigger points and stuff. and that's fine. But the true edge of any setup comes from your ability to calibrate to conditions and understand what's driving the market, understand the regime you're in, understand what matters, what doesn't, what's happened recently, the rhythm, the way the market's moving. That's your job as a trader, and it changes all the time. And so when you might want to take this trade, when you might want to press a little bit harder after you've had a major catalyst that's unusual, not something that's normal, but something that's maybe changed things massively, right? And that would have been many months ago, perhaps something to do with the tariffs or to do with inflation, less so bothered now the market is. Following a narrow range 7-day. So we all know that the concept of volatility expanding, contracting, expanding, contracting, and narrow range 7 days when, especially at the moment when we're in a kind of bull market, the market's contracting, the next light it's contracting in volatility, so it's a narrowest range for 7 days. And Toby Crable talks about that a lot in his book and done a lot of work with narrow range days. The way volatility tends to go is cyclical, contracts, expands. If you're trading a momentum trade like these are, you want to do it when we've had a volatility contraction, because you're trying to get in line with an expansion as well. So this is when the juice really comes out of the trade. And also, if you gap out of a range, it's a higher time frame trade, this type of stuff. So bearing that in mind, let's go back to the targets. You need to decide if it's going to be an A to B trade or is it going to be an all-day hold type trade. And this decision comes from the regime you're in, right? If you are just scalping from here to here, I'm buying this, I'm selling that, I'm taking that break, and I'm going to run it for $30 on the Nasdaq, or I'm going to run it for 100 points on the Dow, 200 points. That's a decision to make, but it's based on the higher time frames. But the trick here, as I think with anything, guys, is to predefine your exit levels. So you say to yourself, this is A to B. If it breaks, I'm going to take it. I'm going to run. I'm going to grab my money. And example might be the moment you're on the A to B short side, because if you're trading kind of US equities, because we're in a bull market, you might be like, hey, I'm not going to try and be clever here unless there's a catalyst or a significant reason for this to be pulling back over a couple of days. I'm just going to A to B it, and being clear about that before you take it, or even if you don't take it. Using your expected ranges, initial targets. So that goes back to that map your market with AI webinar, right? You know what's your typical 15-minute range. You should have that written down before the trading day. Use that as a good framework, and you might say, hey, I'll hold it for 15 minutes, or hold it to that target. And as kind of normal stuff, prior highs, lows, gap fills, they tend to be magnets. So if you're trading a gap lower in a bull market, and you see in fact, there you go, gap lower, bull market, opening reversal, does some work to the downside, then starts ripping, that's a nice catalyst to kind of get into the trade, I think. Time-based exits, I think, are great because you kind of hold it for a certain period of time. If it hasn't moved, you quickly reassess. And don't be afraid to scale out. It's not an all or nothing game trading. Stop sizing, stop setting, fixed ATR stops. Remember, it's a momentum trade, so you kind of don't want to give it too much room, right? Both of those are momentum. And let's look at the charts. If you were kind of trading this type of trade here, and you were buying this pullback, where do you want your stop? You don't want it below the low of the day, right? The idea, this is momentum. So you probably kind of go, well, what's the distance from here to here? I extrapolate that down. That's my worst case scenario. And you kind of judge it. I don't think we can be too precise sometimes and overanalyze things. You have to look at what the regime is in front of you and say to yourself, hang on a second, would this trade be negated if it came down here? Yeah. Would it be negated if it came down? Probably. Would it be here? Well, maybe, but so you make that judgment. You make that judgment before, and you kind of see this rolling, and you go, well, what's the range of the candles? Okay, is this fine? If I do 3 count, okay, you can just judge it based on that. If you were trading the reversal, again, you've got to be a little bit careful with this, because sometimes the open will act as a resistance or support, and you'll see price come up from many times, hit it, and kind of maybe get you in if you're buying on the break, and then kind of finally go. So this one, a little bit more room depending on how you execute it. If you're executing as a close above or below, depending on what you're trading, you might just use that candle high or low as a stop. But a kind of fixed ATR percentage works well on that type of thing. Where do we go for this? You judge the stop based on the regime, the volatility, your conviction in the trade. If you have a higher time frame conviction that you think is going to work well, then don't let it shake you out. Say, I like this. I want to hold this all day because I think we're going to close at highs. The trap has been set. Yeah, you know what? I'm going to give it a little bit more room. Maybe add to the trade, maybe scale in, be a bit more aggressive. The last thing you want to do when you've got a higher time frame conviction is just get kind of taken out of it. Okay, so when to be cautious. Talked about when to be aggressive or potentially aggressive. Be careful when you've got big news or data coming up, right? Because and I both know market can sit around and shop if there's data coming up at 3 o'clock. If it's happened before, fine, that might be the fuel, or the next day. So if it's Thursday, next day you got Friday, FOMC, NFP, etc. You might say, hang on a second, am I really right to take a counter trend momentum trade here? Probably not. Wide range day yesterday often brings narrow range on day two. Be careful of that. Large gap up or down. That's okay, but look at the context, because very often a lot of the move can be done overnight. It just sits there and does nothing. Opening against the higher time frame trend, like I said on that Nasdaq trade today, I didn't like it because it's against the trend. We're at all-time highs, man. I mean, an SMA to be scalping it, fine, maybe that's your thing, but just be very, very careful and be very cautious when you're against the rising tide or a falling tide, depending on market you're in. Clear pre-market structure. So, is what the overnight session's done. Has it done something like some business to the upside, to the downside? Has it been a bit choppy? Just be careful about getting caught in chop. You don't want like a massive erratic candle or low volume doing nothing. Okay, psychological pitfalls. So FOMO, big thing with the open. Look at this from last week, right? Wednesday, you might have traded this as well. You had a face-ripping rally on the Nasdaq. Opened, bang, right? Now, if you weren't on that, you weren't kind of ready, and I think we had the moving average pinged us in about here, right? So it was a bit late, but what it is. It's a profitable trade, but it's a bit late. Now, the next day, I know a lot of traders were going, I'm not going to let that happen to me again. I'm not going to let the market rip off without me. It just ripped and ripped and ripped and ripped and ripped. And so this was the first 1 minute. It gapped up and it popped straight up, and everyone's buying this, thinking it's going to do this again. Of course, the market knows that. And then it just absolutely collapsed and did exactly the bloody opposite, right? Which is what the market does. So be very careful with FOMO. Like I say, the open can really kind of suck you in. Carefully your overconfidence, impatience. You've got to wait. If you don't have a setup when this is rallying, then do not chase it, because it could be this, and you don't know. That's why you have the signal and the trigger, and whether you take these or kind of develop your own. That's the key framework to have in your mind. Fear of missing profit. Listen, the stuff, revenge mindset, confirmation bias. You did it yesterday. That was perfect last week. Everyone was thinking it's going to do exactly the same thing, and it did it completely opposite. Being tunnel vision, identity, attachment. I don't trade this type of thing. I wait for this, blah, blah, blah. You get the idea. So summary before we take some questions, guys. Okay, two core plays. Open reversal, which is where you fade that emotional extreme. Where you kind of goes up and then the trap is set. So we have there's the open, we have the rally to the upside, the trap is set, and then there's the trigger entry. So there's your signal, and this part is your trigger. We have the opening drive, which is the rally, the pull back, and then the go again. And we use the 9 EMA to kind of help us guide that. Be super patient with it. If anything, even if you don't like this type of stuff, but I can't see why. Go back and kind of do your own due diligence, guys. It's happening. But even if you don't like it, just thinking in terms of, okay, what do I need to see that tees up the next thing? And that's that concept of, this is my my signal. I like it. It's momentum. It's a trap. Whatever it is, what do I need to see to now execute the trade? You must have the two, because too many people get caught in like FOMOing in, or it's a trap. I'm gonna short this up here because it's a monster trap, and and then it just carries on and on. It's very difficult to time it. You want a place where you can get a decent entry. You can structure the stop. You can manage the risk. All the stuff that's all the important attributes of the trade, right? Structure is better than speed. Knowing your environment is key. The regime, that's the edge, where the edge comes in. Is the news, wide range day, talks about this low volume, pre-markets chopping around doing nothing. Good green flags, if you like, catalyst, now range 7-day prior, nice structure. You get the idea. Keep your psychology managed on point, be calm, relax, and remember this, right? One good trade at the open can set your whole day up, but it's optional. And the reason I put that is that having that thought in your mind can sometimes cause you to over execute and really dive into a trade that is not there. So if you trade the open, be clear about how you structure it. Do you trade the ORB? Do you trade this fake out? Do you trade the drive? And the reason the ORB is a little bit tricky at the moment is very often there's such a big range in the first 15 minutes or 30 minutes. And so this is a way of kind of maybe you layer that into that. But if you do trade the open, just remember it can be very nice for the start of the day, but you also get the scenario where if you get caught out, it can kind of cause you this FOMO. You're chasing stuff. You don't want to start the day. You feel like you start the day red, you prepared, and now in the first kind of 15 minutes, you've done damage. It can be psychologically quite tricky. Okay, that is what I've got for you, ladies and gents. This worked okay, I think, for chart stuff. I quite liked it. Let me put these up here so you can see. Maybe they're moving around too much for you, but hopefully you see this. Any questions, stick them in. Oh, I've got some questions. I've found the wrong thing I opened up. All right. Hi, Mark. We can't see your cursor on these charts if you point things out. All right. Cheers, Ryan. Hopefully you saw the pen. But oh yeah, good now, the annotations tool. Okay. Xerxes says, if we are spread betting on a CFD, should we use the open price of the CFD? Yeah, that's a really good question. So if you are spread betting via Pepperstone CFD trade, which is a synthetic product, right? For tax purposes, spread betting CFD just allows the different wrapper. Then fine, I think you're absolutely okay to use that because that's really going to be similar price, the synthetic price that they kind of wrap up to make it like a cash product. That's absolutely fine. So use that 8 o'clock level if you're trading the DAX. What is the best? Susan Nell says, what is the best time frame to use this? Susan, the opening drive trade is a 1 minute, right? So it's a 1 minute chart because the 9 EMA is a different reading when you're on a 3, 5, 15, right? Because it takes the candles. So that's the only specificity with time frames is on the opening drive trade. The open reversal, you can use whatever you want, but you must, I think you must have at least 7 minutes or so of movement in one direction before it reverses to be valid. You can tweak that, adjust that. So watch it. If you're watching on a 5 minute time frame, you need probably 2 candles, and then it comes back on the third, earliest, sorry, a 3 minute. You get the idea. So that's really time frame agnostic. But the opening drive is the only one where you want to see use the 1 minute because that's the 9 EMA. For whatever reason, the 9 EMA seems to hold price. I don't know why. I don't know. Who cares why? David says, let me bring you guys over here. Let me bring you over here onto the main screen. If trading in 1 minute, what time frame are you building your open plan? The top-down process, try not to overtrade, but I want to plug this in somehow. It seems to make sense to make the plan on the hourly. You've got it, David. That's exactly the process. Thank you for bringing it up, sir. So, there are times perhaps when you have a surprise open and you go sugar, YouTube, sorry, Pepperstone, you go sugar, it's rallying hard. There's some sort of reprice going on. Okay, great. Let me now wait for the pullback and get on board. There are some times you get that, but most of the time, what you say is correct. You have the thesis on the higher time frame, and you say, hey, if we get one of these two things in the long direction, I want to take it. So you might see the gap lower. You might be like, hey, we are moving to the upside on the higher time frame. I want to stay long. Okay, how do I get long? Well, this is a way you can use this as a setup to get long in a higher time frame idea. So you do the analysis higher time frame. You say, hey, if we drive, I'm buying at the pullback. If we kind of fake out the open, come back through the open, I'm buying that. Use it as a way to get into the trade as a kind of structured way to get in. So sometimes you do get this kind of these moves as we had the other day, but you could also use it as part of a higher time frame thesis. Yeah, it's a great question. That really good question. You guys really have some lovely questions. Thank you. Eduardo says, hi Mark, can't the first setup also be considered as open rejection reversal, one of the key IB opens? Yes, Eduardo, absolutely, mate. You are right. There's 4 or 5 of them, different reversals on the market profile concepts. Not market profile. What's it called? Dalton does it. Is he profile? Forgotten. Yeah, exactly that. It's basically that you go in one direction, you trap a load of traders and roll back. I like that type of stuff, But why I kind of bring it up today is that I've just seen it and seen it and seen it and seen it. These two type of open or three choppy doing nothing, the drive and pull back out of nowhere, and then this reversal that traps traders. So yeah, you're right, and you can go and study. I think it's old Dalton. Dalton was the king of that, wasn't he? Jim Dalton, and I think he does a really good way of categorizing some of the opens. Someone can correct me if I'm wrong with that guy. Uh, David says, when you just so you say structure, how exactly do you decide that? Um, I think you mean like to me that's the regime we're in. What's the catalyst at the moment for the market? At the moment we're in uptrend, bullish. We're shrugging off bad news, good news we're getting ripped up on, and so the regime for me is if I get along a level, I want to kind of hold it as long as I possibly can. If I'm shorting, which I'm very cautious about, I don't want to be an A to B. Now, you roll back the time when we had tariffs, it would be completely different. It would be like, well, hey, the regime at the moment, the structure of the market is very whippy, very sensitive to news. You probably don't want to hold stuff too long. A to B, even though your A to B is quite wide, go back even further when we're kind of selling off systematically, you flip that on its head. Oh, there's a lot of questions here. I didn't think you'd like. I'm not sure if this one would hit, but it feels like maybe it has, or maybe I'm not being clear enough. So one or two things of the questions. One of you guys are, yeah, like this. Tell me more. I'm kind of want to might wrap it into my trading. I want to do this, want to do that, or it's I don't know what you're talking about, Mark. What either one or the other. Um, I've been following the process of Gregor and Sol Lockyer from your podcast. A 5 minute break and retest 1 minute entries. Listing their episodes really cleared my trading up. Well, good, David. Thank you. Yeah. Why not plug the podcast while we're here? David, is a £5 note for you. Well, yeah, I've got a podcast, guys. Go to tradersmastermind.com. Some of the headline episodes, if you like, are under the podcast section. Sol Lockyer is the CEO of the Fivers Group, and he talks about some of his own trading as well. That's one worth listening to. Gregor is the developing trader episode. He has done very well over the years in improving his trading. A couple of other headline ones is R2 Kokilla. He's a hedge fund manager who day trades Forex. Tom Hugard we've had on. I'm missing a load out here, but I have some great guests on. Brett Steenbarger, of course. Got another good guest for you coming up next. I want to say a couple of weeks. But yeah, thank you, David. Glad you like that. Where are we? Panos says, wouldn't it be better to have a fixed TP according to historical data for all trades? A to B does not apply most of the times. If it breaks, it might reverse at the end of the day. No. Yeah, you know what, Panos? I think that's a great idea as well. And that's why I say map your market. So I don't, if you were at the last webinar the time before, we kind of use historical data to say how far do we expect the 15-minute range, opening 15-minute range to be for your market? How far do we think the daily range could be? I think that's a great way of doing stuff. But you also have to be, I think, aware of the regime you're in. So if you're shorting, let's say, the opening range failure, so the open failure drive short, you're in a bull market. My thinking is the low will probably be made will be made later, and then we'll make a new high later in the afternoon, and that will be the range of the day based on historical data. So I'm being a bit more quick and to take my profits as opposed to the other way around, where if we get a kind of move to the downside and then we rally up, I might think that's the low of the day in because we're in a bull market, and very often the lows are made early, highs are made in the afternoon. So I kind of frame the way that I look at stuff, but that's a great way of wrapping it up. Sandeep says, interesting concepts, much appreciated. I like the new way of presenting. Thank you, Sandeep. Appreciate your feedback, pal. Gary says, great stuff as always. Thank you. Thank you, gentlemen. Andrew Lake says, hi, Mark. Is it worth trading the open reversal setup on the 5-minute chart, or is it better to trade the 1-minute chart? It doesn't matter, Andrew, as long as you have, from my perspective, at least 7 minutes worth of action in one direction. So if you're trading the 5-minute chart, you want 2 candles to give it 10 minutes before you take the reversal. It's only that one. It's only the drive that really I think is important at the moment. Sorry, the time frame is important for that. Okay. Thank you, Rob. Hey, Mark. Good info as usual. Thanks. Appreciate you all, guys. By the way, I tend to look at the 5-minute orb. Oh, this is Sandeep. I tend to look at the 5-minute orb, but we'll also consider these. Will you be covering the orb in the future? I probably won't, Sandeep. Let me tell you why. Because if you go to my website, I did a big. Did I do? I'm saying this like I'm sure I've done a webinar on the opening range breakout. I must have done. I must have. I'm confident I've done the opening range breakout, Sandeep, before. Maybe we'll cover it some ways to add to the flavor. But like you say, if you trade the open, this is a way to really get in a little bit earlier on stuff. And if you sometimes you feel like you're a bit late with the orb, you can kind of use this as a leg into the orb almost. And there's some guys like to do this and say, hey, well, I'll use this. I'm a bit early. Now I'll manage it like an orb type of trade. You have to excuse me, ladies and gents, me scrolling through. Have you got any tips for trading the Asian overnight range? I'm interested in trading the DAX at pre-market time, 7 a.m. till 8 a.m. Thanks for involving. I don't actually, Arta. I tend to trade the US session predominantly 90% of the time. There is a webinar. There is a podcast done by Gregor who trades, I think, pre-market. Wouter as well. I think it's called. He trades just pre-market, and there's also a podcast. This is on my podcast episode. Anthony Vallone, he trades FX. He trades like an Asian session breakout. So that maybe that will help you, pal. Beth says thank you for a great webinar. Thank you so much. Chris Robinson says thank you. He doesn't say thank you at all. I'm lying. He says hi, Mark. Awful webinar. No, he doesn't. It says fantastic webinar. First time I made it to the live sessions. Great ideas. For the open. Thanks for your time. Appreciate that, Chris. And you know what? Live gets more energy. And you know what? I like this as well. If I go to live stuff, I pay more attention. I take away more from it. And from a selfish perspective, I like the questions because it makes me realize that actually I've hit the mark with stuff. So I can, and if I don't get many questions, I know that, I need to adjust and adapt because just because you've got a couple of decades experience doesn't mean you can just spout out nonsense. Sorry, I don't know why it doesn't go back to. Maybe I'm managing the questions incorrectly. Is orb working in Forex? Ivan Teddy says, I'm not sure. I haven't traded Forex for a long period of time. I would say it's probably not as good. Someone's going to say, I've been trading it very, very well. And I think maybe it's not as good, but you know what? I don't even know the answer to that. I'm making up my answer because I've not been focusing on Forex for a while. I think there's enough opportunity in the NASDAQ at the moment. Which HT do you recommend to look at the market open? Which time frame? Higher time frame do you recommend? He's saying. You know what, the time frame questions, guys. I think that like I say, the only one that really matters on the time frame you have the chart on is that 1 minute because the 9 EMA is different. I think this applies to anything. Like the price is the price. If you're watching price movement on a 15-minute candle, sure, you're only getting 4 pieces of information versus 20. Am I right? With a 5-minute, and that's on the chart. But if you're watching it, it's still doing the same thing. It's just visually how it looks. So don't worry too much about the time frame. The price is still doing exactly the same thing. It's just how it's pictured and visualized. And if you want more information, then go down the time frames. If you want less, go up the time frames and find that sweet spot. If you're over trading, go up the time frames. If you find you don't have enough information to make a decision, then go down the time frames. Don't get too caught up in which time frame gives you the best signal, so to speak. It's only if you're using the moving average that matters, because that is obviously based on 9 minutes as opposed to for a 10-minute time frame, 90 minutes. And so just when sometimes I'll be sitting here looking at a daily because I know in my brain the price I want to get involved in, and then I'll go down maybe to a 1 minute to finesse the entry. I won't sit there staring at 1 minute all day. Maybe I'll have the other day I was using a 3-minute for a while, but I wanted to see 5 days worth of data and kind of step back and go, hang on a second, look at that. And then I could go in and do a bit more research and dig in. Whether that was a 5-minute or 3-minute kind of didn't matter, but you adjust the time frame to suit what you're trying to achieve. Yeah, so time frame for the higher time frame. Thank you, Dave. Executing on 1 minute. What higher time frame you're referring to and checking the trend? For me, it's really the daily. The daily is the one that matters. I know for some people that's very, very high, but that's the okay. And I also appreciate you might have a couple of days of down move in a bull market. You get pullbacks, you get backfills, you get congestion. Absolutely, you do. But when we're at all-time highs, when we're bull flagging at highs, I know the likely resolution for that is to the upside. Probably won't now, said that. But so I kind of look at my day trade and say, well, if I'm sure, what am I really expecting? Are we really going to get a heavy down day here, the big fat red candle? Probably not. More likely, and again, probability is how we work, more likely to get a large range green candle. So let me align with that and try and get long on my day trade. So even if I'm not going to get the whole day's move, I know that that's potentially where the pressure is. So let me take the easy route. I don't want to play the game on hard mode. It's tough enough as it is. And I understand this is controversial, not controversial. This is what's the word I'm looking for here? This is the word I'm looking for when you have people on both sides. Splitting of people. I don't think of the word. You get the idea, right? I know that some people sit on one side and go, it doesn't matter what the daily's doing, I'm trading the intraday. And I appreciate that and I accept that. But for me, I want to make sure I align with the higher time frame trend. Rising tide lifts all ships. And if you look at the intraday chart, moves to the downside aren't very long because for a trend to continue, it has to take out highs. So just by the nature of an uptrend, the up moves are going to have a magnitude much bigger than the magnitude of the down moves. Doesn't mean you can't trade short, but also just being aware that that's where the most of the juice is going to be in an uptrend. So I know it's simplistic, but hopefully that makes sense as to why I kind of tend to align. Or if I'm holding a trade, it will only be in the direction of the trend. A to B trade, I'm okay taking shorts, but I'm very, very mindful that just by nature of an uptrend, they're likely to reverse, and we like to put in fresh highs because that's what uptrends do. Okay, are you using the VWAP in any way? Simon says, yes, mate. I didn't put it on my charts because I wanted to keep them clean, but no, please, pal. Yeah, absolutely, mate. VWAP is number one thing on my chart. Very, very useful. Use the regular trading hours session, rotate from the 24-hour to the regular trading hours. I've done a full webinar on that. If you go to the Pepperstone YouTube channel or you go to tradersmastermind.com, in there you will see loads of stuff on the VWAP setups, VWAP trades. I love the VWAP. I think it's one of the best indicators to have on the chart. But thank you, Simon, for bringing that up. If I've skipped some, I do apologize, gentlemen and ladies. Justin says, hi, Mark. Thanks so much for this. Absolutely love it. Good. In your experience, is it best to use the London Open for the DAX using the open reversal setup as opposed to the Frankfurt Open? Yeah, 8 a.m. is the best for that, I think. I'm still here. I'm scrolling. Is SMC useful? You know what? It's just a different threat. It's just a different wrapper on stuff that's been going for ages. Wyckoff stuff, Toby Crable stuff, Taylor trading. These boys have been doing it since the 19, whenever they were. Smart money concepts, ICT, whatever his name is. He's just put a different wrapper on things. Turtle Soup, Linda Rashke had that, coined that. This is none of this, so fine. I've got nothing against anybody who makes something their own. Absolutely, I haven't. I never have anything against anybody doing the right thing and trying to do the right thing. People do it different ways. That's fine. That's what human beings about. But just remember that a lot of these things, they aren't the holy grail. They aren't the they call something silver bullet, right? Their patterns are generally you've got people trapped. There's your turtle soup. That's a Wyckoff spring. Liquidity grab is a Wyckoff spring type trade. Wyckoff was doing this. You've got these momentum trades. All this stuff was happening years ago. It's just framed differently. Now, if that helps you learn it, then I think it can be useful. If you look at that SMC and go, hey, smart money concepts that make sense to me, blah, blah. There isn't smart, in my belief, there's no smart money out there. Look at the hedge fund performance, right? They have times when they make killings. They have times when they don't make so much money. Just like us traders, we have times when we do very, very well, years of excellent growth, and then maybe a year of stagnation. Maybe, you have a year of a couple of quarters of drawdown. There's no one knows what's going on in the market. So I think there's a little bit of a fallacy with This smart money. Now, are there people who are more profitable than others and are more frequently profitable? Of course there are. And if you categorize those as smart money, then these are the guys who are trading the springs. These are the people like you and I who are waiting for the trap to be set and then trading the trap rather than jumping at highs. That's dumb money, so to speak. Smart money, so to speak, is waiting for the trap to be set and then trading the reversal. That's the way that I look at stuff. Thank you, Eduardo. Says Jim Dalton is correct. There are 4 types of opens: open drive, open test drive, open rejection drive, and open auction. I now remember them. Thank you so much. David says, is there a reason a lot of the professionals avoid FX on the lower time frames? You, Lance Beggs, Trader Dante, a lot more. Lance Brightstein, Lance Beggs. I just don't think there's any edge there. That's my personal opinion. I don't know what those guys think. Probably the same, right? Those guys have been trading the same sort of thing as me. It's a couple of decades. I don't think there's much edge on the real lower time frames. Now, I have seen traders do very well trading FX. I just think it's trading it on hard mode. And I'm not saying FX generally. I'm saying FX on the lower time frames. I think that because you're trading, and again, I don't know if I'm right on this. I'm just a dumb trader who goes where I think the edge is and what's working, I double down on it. And so I'm not saying that there isn't edge there, but I've not explored it because I think what the edge is elsewhere. And why I say this is this, and this is not to offend any FX traders out there, but you are trading a ratio. You're trading one currency against another. And so for that to have a big drive in one direction means one's got to be persistently weak, one's got to be persistently strong. And so on the very short time frames, you have this scenario where, very often, they're going to move in a direction and it's going to mean revert. It's going to move in a direction, it's going to mean revert. And that's okay if you're that type of trader. But if you're the type of trader like me who wants to get on a move, maybe add to the position, try and stretch it, I just think that they happen more frequently in the indices at the moment. You get a lot of that in the NASDAQ type of stuff. DAX at the moment, you get a lot of that type of stuff, and some of the individual stocks. But that's basically because of the way you trade. Now, if you are kind of happy trading 30 pip rotations and this and the other, then fine. But just know that's not going to give you the outlier type trade. So I think there's nothing wrong with it. And I think maybe you can cut your teeth on it and you can kind of understand price action and really get to grips with some of these lower time frame stuff. But if you were saying to me, David, you said, hey, you know what should I trade? And I'm not here to give advice or anything. I would say, listen, focus on stuff that's moving, where there's edge. So the moment the NASDAQ is moving, the moment the DAX is moving, you might say, well, that's too volatile. And I say, okay, we'll try. Well, gold is moving. Okay, fine. The currencies today, we've got some movement in there. And I think on the higher time frames is where there's probably much more edge with the currencies, because you get that kind of the shift in macro sentiment, which then drives the currency, which then has that persistency of trend. So I think you get that. Whereas on the short term, I think that there isn't as much edge. Have I explained that correctly? I hope that's made some sense. I guess the short answer is I just think there's more edge for me on the other stuff. Right, last few questions. Thank you, guys. Fantastic webinar. Yep, thank you very much. Appreciate that. Thank you for today's webinar, Sandeep. Thank you very much. Thank you very much, Clint. Thank you. A great session. Thank you so much. Will this be available after? Yet you'll get a copy of the recording, Clint. Thank you. Mark says, Mark, thank you as always. Great stuff. Appreciate your time. We'll watch again. Thank you, Mark. Nina says, thanks a lot. Appreciate that. Jacob says, is it optimal efficient to trade from one Z zone to another? Yes, so I call that A to B trade, Jacob. So you kind of have a zone of, I'm assuming that's what you mean, like a support zone or resistance zone, and you kind of look for it to go to the next level. So if you were trading these open type trades, you might say, hey, there's a higher time frame resistance there. I'm looking to hold that trade to there, or I'm looking to hold the trade to a support here if you're short side. That would be your A to B trade. You plan that out. Now, maybe you'd scale out the position at that point, or maybe you would take the whole position off, but you'd make a commercial decision as to how you would trade that or not. Good question. All right, ladies and gents, thank you so much. We run on, but I appreciate your questions. I'll stay here and answer your questions all night because I love talking about trading. I love the markets. They've been kind to me, and we're lucky enough to have found something that we're good at. So that's great. All right, guys, take care. Next week, we're talking about confirmation, the little kind of subtle a balance between waiting too long for confirmation, so to speak, and actually seeing the market doing what you want it to do. There's no perfect answer to this, but hopefully we'll solve a lot of those questions for you next week. Thank you, ladies and gents. I appreciate your questions. I really, really do. Thank you. Take care. Keep your risk managed. See you in the next one. Bye-bye.